Good afternoon. We're going to look at chapter 16 homework. I'm going to very quickly go through here with a lot of writing on the board here. Let me go ahead and share the screen for the first problem. All right, so what we see there, Ganesh Products acquired a 2.967 million face value, 7% bonds, so that's the amount of cash we expect to receive every year. Of course, 3.5% if it was twice a year. But in this case, it is paid annually, as it states there. So we're simply going to take 7% of that 2,967,000 to get the cash amount. You can see it here in the solution, 207,690. First of all, we need to put this on our books, this investment that we have. And our investment says that purchased the bonds, which means that's the cash that was invested, 2,340,862. So there's my investment, there's the cash. And so the difference between that and the 2,967 is a discount that's going to be amortized. So over time, it's 2,340,860 is going to be amortized up to the face amount that I expect to receive back in cash. So there's the entry for the held to maturity debt, and it tells us it's held to maturity. Right? And so we don't recognize comparison to fair value unless the fair value option was elected, which we have an exercise like that, I believe, number 10 of these 10 exercises. But for purposes in general, for purpose of this exercise, there is no comparison to fair value, even though it gives you the fair value of the bonds. 2,185,945, we don't do that comparison. So there's the cash I expect to receive each year. Interest revenue, how do we calculate that? Well, that's just simply the purchase price of the bonds in this case, minus the interest, right? 96,622 is going to be my discount amortization, but we have to multiply the market rate times the purchase price of the bonds. Now, if you were doing this continually each year, it's not the purchase price of the bonds every time because it changes. It's the purchase price of the bonds is the carrying value, right? 2,340,862. If I move that over there, there it is. But we'll see another exercise later. If you were doing this entry for the second year, you're going to get a different amount for the effective interest. It's going to be 13% times the 2,340,862 plus this 96,622. So 2,340,862 plus 96,622 times 13% would give you your interest revenue for the second year. But I'm going beyond the scope of this problem and what I'm telling you there. All right, number 2. Another bond investment, debt investment, right? Bonds, debt. And this is a available for sale investment. So here's where we are going to compare to fair value. But first of all, we got to put that on our books at the purchase amount, 3,081,288. There's my cash. The cash is the payment I expect to receive, which is 10% of 3517000. That's 351,700. Because again, this is paid annually. Now, if you go back and look at chapter 14, about all of those were, and that's where we were actually selling bonds. Here we're purchasing bonds, but when we were selling bonds, about all of those were 6 months, semi-annual. I don't know why they chose annual for this, but typically they're the same. And what you see here is the cash for the year. There's my interest revenue, which again is going to be the carrying value, which in this case is 3,081,288 times the market rate of interest. And there it is, 3,081,288 times 12%, 369,755. But again, that only works using cash, that only, or purchase price, that only works for the first term. The second term, you then have to modify based on this discount and increase 3,081,288 by 18,055 to multiply by 12% for the interest revenue for the second period. All right, so this, since it's available for sale, we want to do a unrealized gain or loss. So it's given up here at the top that the fair value of the bonds at the end of the year is 3013. All right, there it is. There's my beginning investment balance. There's the discount amortization. So we're up to 3099343, right, in our T account. And so the difference between our balance on the books and the fair value is a loss of 86,343. So we have lost value. We haven't sold anything. We have a holding gain or loss. We have a holding loss in this case. So we want to show that loss here in OCI, which is on the balance sheet. All right, right there it is. A loss debit goes to my balance sheet because it's fair value adjustment here is going to be a contra account against my investment, available for sale debt investment. So 86,343 is going to reduce the balance of my investment. All right, number 3. All these, I got 10 exercises here. All these are good exercises. Here we're looking at the third one. First exercise was held to maturity. The second one is available for sale. The third one is trading. Now, there's really no difference in the process for trading and held to maturity. Excuse me, trading and available for sale. Both of those are going to use the fair value adjustment. Held to maturity does not, unless you elect to do so. Held to maturity simply says we're going to hold this to maturity, so you would not have a gain or loss if you hold an investment in bond to maturity. Like investing in a CD, you expect to get the full principal back and interest. And so what we see here is trading debt investments 3061198. There's my annual cash receipt. Yes, it is paid annually again, which is going to be the face value times 9%. There it is, 3518 times 9%. There's my cash revenue I expect to receive. My purchase price of the bond times the market rate. There's the interest revenue for the first period, 336,732. And the difference is my trading debt investments, my asset is going to be increased, right? Yes. And so my calculation for the second period, of course, there's not a second period here, would just simply be 3061198 plus the 21,112 is what we'd multiply 11% by to get the second period. But the question here is, what fair value adjustment do I make at year end? And that's where we take the fair value of the bonds at the end of the year, 3016, and compare that to my book value. So 3061198 plus the 21,112, there's my new investment balance. Fair value at the end of the year, so there's my unrealized loss, 65,310. All right, number 4. Let's jump over into equity investments, stocks, right? Here we acquired 37,000 shares of Gibraltar Corporation at $32 per share. Investment does not allow Jekyll to participate in the decision making, or as we know that means there's not significant influence. So there it is. Does not have the ability for significant influence over this company. So we're going to use fair value method instead of the equity method. So there's my investment, 1184. And then at the end of the year, there's no amortization, right? Because we're talking about stock investment, equity. We're going to compare that to fair value. And fair value is $1,443,000. The original cost is $1184. So we have a $259,000 gain, don't we? So that gain is going to be a debit to fair value adjustment, which is going to increase my asset balance, right? Which is what we want. And then that unrealized gain or loss is going to go to the income statement. You know, that's what's changed under the new rules in our text, which is in our homework here. Available for sale and trading are now one. Both go to the income statement. If you read that Warren Buffett letter that I have out there on the material and content, and the content on D2L, Warren Buffett talks about this change in accounting. That's great reading. If you want to go out there and read his letter from a year ago, maybe in this year's letter as well, I haven't checked. But taking these unrealized gain or loss, these are holding gains and losses. This is a holding gain that you're taking to the income statement. Kind of incredible in a way. Then number 5 is another stock equity investment exercise. And what we're looking at there is the equity method, because in this particular case, it says they acquired 35% of the outstanding voting shares. So that's more than 20%. Remember, 20% is the threshold. At a cost of $1,808,100, current $28,782,000, that should be 35%, $63 per share. So we're going to book that portion of income. We don't care about fair value or stock price. We care about net income and the dividends. So there's my net income that we're going to debit to investment in Galasso Corporation, 304,850. And there's my income from investment that goes to my income statement, but there's my investment. So see, we're increasing this investment. We don't do that in a fair value method. And then the actual dividend payout is a reduction. That's unusual, but think about it. If you're got a significant influence, 35% in a company, and they're paying out dividends, they're reducing their retained earnings to pay those dividends, aren't they? So we receive the cash, but we also have a reduction in our investment because their retained earnings, when you've invested in, their retained earnings has gone down. Their equity has gone down. All right, it's good exercise. All right, how about number 6? Here's another 45% interest in the common shares of Prince Entertainment at a cost of $4,290,000. Report a net loss of $626,000, paid no dividends. Market value equal to book value of its net assets. So investment in Prince Corporation, $4,290,000. There's my investment. And then we have a loss here, $626,000. What portion of that is ours? Well, 45% of that. So that's $281,000, loss on equity investment and reduction investment in Prince Corporation. I'm not sure what JCPenney has to do with it. All right, very straightforward exercise. Number 7. Now, what I've stated in the other video and in class is held to maturity means you're going to hold up bond investment till the end. And in that case, you would never have a holding gain or loss because all your holding gains and losses would offset by the end because you never have a gain or loss if you hold a bond till maturity. But you have the option here. GAAP allows a company to use the fair value option. And in this case, that's what they've elected to do. They adopted the fair value option for a recent acquisition of debt investment securities that were originally classified as held to maturity. All right, that says the actual investment was $1,108,000. There it is. And it says that the fair value, year-end fair value of the debt by Inkstain was $1,307,000. So the difference between those two, we're going to write that up, right? Because it's gone up in value. So we want to take the difference, the cost of the bonds, and now the fair value. So we're going to write that up as a holding gain or loss, unrealized holding gain or loss. Now they don't put holding in there anymore, but that's what it used to be called. Very straightforward, but that's held to maturity fair value option that's been elected. Right now we're getting to one a little bit more detail when we have to calculate present value. Now we did that back in chapter 14 when we were selling bonds, right? Well, it's the same principle here. It's just that when we were selling bonds in 14, now we're buying the bonds. It's like we're the people who were buying the bonds back in chapter 14 from the transaction we were making for selling bonds. So it's really the same calculation when you look at what the solution is. You look at the 7.53 face value or par value times 8%. So 8% times 7.5 million is the actual cash we expect to receive. Now, this says they're paid semi-annually. So if you look at the solution here, they're taking the market rate, 18% divided by 2. We're going to use 9% in looking up these tables. that are there, which is table 2 and table 4. Or we'll use Excel, because Excel must be used in order for Pearson to accept the answer as correct due to rounding. The stated rate is 8%, but that's really 4% every 6 months. And if you got 20 years, that's really 40 periods, right? So 9, 4, and 40 is what's important. 9% is the market rate, which is, we're going to use that for the amortization. All right, so there's my face value times 4%, 301,200. That's the semi-annual amount. So if we plug this into Excel, there's my 0.09, right? The market rate, 18 divided by 2. There's my 40 for a period. The 301,200 is the actual payment right there for 40 periods. And then there's the future value that I expect to get back from my investment. Remember, bonds payable is always, in chapter 14, is always face value. Well, it's the same here. So what is the present value of that we're going to put on the books? 3,479,854. That's a huge difference from the par value up here. But that's because you're only getting 8%. Me, as the one investing in these other companies' bonds, I'm only going to get 8% when the market's paying 18%. So that's why you see such a large discrepancy there. So 3,479,854 available for sale debt investments. So the first period, I'm going to recognize interest revenue, which is going to be 9% times this balance of my available for sale debt investments. Right there. 3,479,854. They say purchase price, but again, this is net of after you're doing the amortizations. And so there's not any amortization except this is the first entry. 313,187. That's my revenue based on the effective rate of interest method. So 313,187. There's my payment. And so the difference is what I'm going to amortize. 11,987 straight against this available for sale debt investments. All right, so there's my entry. If we were to put that on a spreadsheet or put that in a T account, that 3,479,854 would be increased, right, by 11,987. So 3,479,854 plus 11,987. Both those are debit entries. Will give me a new balance for the second period. So if I look at the second period entry down here, which is probably requirement C, there it is, 3,491,841, right there, times 9%. That's for the next 6 months, is 314,266, and now my discount's going to be 13,066. So we jump back over here. There it is, 13,066. So it's going up. And so now we have a new balance, don't we? Requirement D, 3,491,841 plus 13,066. So now we've got a new carrying value of 35,049,07. Again, the original purchase price plus 11,987 right there. There's the original purchase price plus 11,987, 34,91,841. Add the 13,066 for the second 6 months. There's my new carrying value on my books. And then the difference between the fair value that's stated up here and the problem, won't let me highlight it, 51,97. That says I've got an unrealized what? Gain of 1,692,293. And so looking back over here at the solution, there's my debit, the fair value adjustment for my gain. I'm increasing an asset. And there's my credit that goes to OCI. Because again, this is debt. We still go to OCI for available for sale. All right, another good exercise. A little bit involved to go through there. All right, then number 9. Here's a stock investment. There's my original investment, $531,500 for Aiden and $786,310 for Golden. That's $1317,810. Then at the end of year one, what's my fair value adjustment? Well, the price now is what? If we take 10,630 times 56 and also 8365 times 85, add those together and subtract this original cost, then we have an unrealized what? Loss. 11,505. There it is. There's the original requirement A calculation. Requirement B, fair value adjustment. There's the 10,630. All right, 10,630 times 56. And the 8365 times 85. So there's my fair value at the end of the year. The original cost was $1317 that we put in right there, right? $1317,810. And so we've got a loss of $11,505. And there wasn't a balance in there to begin with. So the $11,505 has to be input as a loss and fair value adjustment, a credit, which reduces my asset. Then they make it a little bit more complicated, but that's good. It says, assume that Hessler sells 5,400 Aiden Company shares for $58 per share at the beginning of the year. Prepare the journal entry to record the actual sale, because all this other is just a holding gain or loss. And we're going to correct the fair value adjustment after we record this. All right, so what does that look like? Well, let's scroll on down here to the solution. So we sold 5,400 at $58. There's the $313,200 right there. The cost of that was $270,000, right? 5,400 shares sold. There's the original cost, 50. So there's 270. It's got to come off our books at cost. And so the difference is a realized gain of $43,200. And so then part D is the tricky part. What does that look like? Well, we got 5,230 shares left, right? We had 10,630 shares purchased, minus 5,400 shares sold. So we got 5,230 left, times 51 is the market price. There's the 8365 times the market price. And again, this is year two market price. So my fair value at the end of the year is 101,950. And the original cost, which we have to calculate there, that 5,230 remaining shares times $50 original cost. Of course, if you do this in a T account, it's going to tell you what this is. 261.5 and 786,310 is 104,710. So that says that we should have in our T account a cumulative ending balance of 28,230 as a credit, right? So if we got a credit, if we need to have an ending credit balance or an ending credit balance of 28,230, you know, we had a 11,505 balance to start with, right there, going back to year one. That's a credit balance right there. Clicked on the wrong one. Fair value adjustment. We've got a credit balance there, and the credit balance should be 28,230. So how do you get from 11,505 to 28,230? We're going to have to we're going to have to debit, right? 16,725 to lower this 11,505 to 28,230. And there it is. Fair value adjustment, 16,725. Excuse me, I said that wrong. We need to have a 28,230. If I can put it on here. Fair value adjustment. Our balance was 11,505. And it needs to be 28,230. 230. So we need to make an entry for 16,725. Stop my screen share here. Fair value adjustment. You see the credit balance there, 11,505 from that year one, right? Year one. Year one, 11,505. And then year two is 28,230. The 16,725 there in red, that's the entry we have to make for this thing to balance. We have to force it. It's kind of like, what do you want your general ledger to look like? So that's kind of unusual to look at it that way. But if you recall that vacation accrual exercise that you worked on and that you had to turn in, remember the adjustment, the last of the 5 journal entries, you had to make that true up, as I call it, of the accrual for vacation. Well, that number is just something to make the thing balance because you knew what you're going to pay out the rest of the year, right? Same principle here. I'm going to go back and share this again. We'll finish this last one. All right, so that's good exercise. A lot of math involved, but that's what's important about this class, is learning the technical side of this and making these journal entries and keeping up with things. It's very important. And learning the theory behind it. All right, then the last one here, we have an equity investment in Kamzu for $102,000. Using this, it says lessor accounts for the equity investment by using market comparables. It says their equity is not actively traded, does not have readily determinable fair value, but fair value is estimated $104,500. Does not have significant influence. That's the key term there. So if you don't have significant influence, that means it's less than 20%. So all we're going to do here is fair value. There's 102,000, and if this thing fair value 104,500, then we have what? We have an increase there, fair value adjustment of 2,500. 102 plus the 2,500 tells us what the actual balance should be, and we take that to the income statement, as you do for anything that is not significant influence. It used to be trading and available for sale was used with equity like bonds, but no longer. That's changed. All right. So that is chapter 16 homework. Very straightforward. I'll focus on what's most important parts there. But we'll talk again soon. Thank you.